Golden Investment Rule, Phil Town, becoming a millionaire investor based on a miraculous letter. In his view, investment opportunities always come with risks. Greater risks also mean that the challenges are gradually increasing. Only when the conqueror has too little experience and capacity, then the risks just turned into disaster. In March 2016, Investopedia made an article about Phil Town's portrait. He was dubbed the successful and transversal investor in the period before successfully applying the principle from the early giants. Private investment and build a style of investment for themselves. This story is titled Portrait of a Successful Investor with the 4-letter M criteria. Phil Town was born in 1948 in Portland, Oregon. During his youth, due to his family's difficulties, his study path was not as favorable as his peers. During a military service recruitment, he registered for military service for a period of 4 years during the war between the United States and Vietnam. In an interview with the press, he recounted a difficult time after returning from a fierce battle. After returning from the Army, Phil Town chose a job as a tourist guide on the river, owned a middle school diploma and had to take up to 4 new passes to the University of California, majoring philosophy. Even when he graduated from university and graduated to 6 years, he still could not orient his work to suit himself. Knowing about the stock market happened to come to Phil Town after only once did he risk his own life to save a tourist who suffered from high water rowing. Touched by his bravery, the strange guest, who was also one of the famous investors of the time, volunteered to guide him on the first step of the road to the investment. Later in the interview, Phil Town kept referring to this benefactor with the inscription, "Do you know, Phil Town, I can give you a fish. But I didn't choose. I will teach you the knowledge that is worth more than 1,000 times the bonus I can give you." Luckily for Phil Town, this investor taught him how to think like investment myths like Graham and Buffett. And with only a single investment rule, rule number 1, don't lose money. Investment rule of billionaire Warren Buffett, within 5 years, 1980 to 1985, in his view, investment opportunities always come with risks. Greater risks also mean that the challenges are gradually increasing. Only when the conqueror has too little experience and capacity, then the risks just turned into disaster. Phil Town as well as Warren Buffett emphasize the power of compounding. The proceeds from the initial investment continued to be invested to generate profits. According to the original version of Rule 1 #, Phil Town's principle is to get 15% of the average yield he achieved. In the same view as Buffett, Phil Town combined with the power of compound interest and thought of the 4M principle to select stocks that represent businesses worth investing. The set of criteria includes 4M words, which he still emphasizes to the main investors, meaning, moat, competitive advantage, management, manager, and margin of safety, bien and full. 4M set of criteria for selecting great stocks. To buy a stock, according to his principles, investors need to answer the following 4 questions in order. 1. Meaning, does the company's business mean anything to you? Does the business of that business mean to you? 2. Moat, competitive advantage, does the company have a good competitive advantage? 3. Management, manager, does the company have a good and honest executive board? 4. Margin of safety, does the stock price you buy have a good margin of security compared to the real value of the business? More specifically, the elements in these 4M words are explained by him as follows. Meaning, the first 2 questions every investor needs to ask himself when buying a stock are: 1. Do we really understand that business as part of our lives? 2. Are we willing to hold the business as its owner? Besides, he also advised individual investors to invest in companies operating in areas that they can understand or learn by themselves. Thus, the immediate objective can be convenient for companies in the array that they are working in. Professional knowledge about a profession we are doing is an important factor that helps you succeed when evaluating a business in that area. Investors can also choose companies whose products they use regularly, understand and like. Or choose the array that investors are full of excitement to really understand. Moat: does the business have a good competitive advantage, that is, its ability to protect itself from market competition? If you know this, always monitor and ask when the business loses this competitive advantage. Management: how effective is the executive board of the company? Whether they are willing to benefit themselves and harm shareholders. A business that has a competitive advantage, high growth and profits, and not a lot of debt can still be a poor company if its self-interest leader or falsify the financial statements. And the assessment of people is not easy, especially with the transparency of marginal and emerging markets still limited. Margin of safety: the margin of safety is the ultimate principle in value investment, helping to reduce risk and ensure sustainability in any investor's decision. The most easily defined safety margin is the difference between the price of the stock you can buy and the actual value of the business. When the investor buys the price lower than the real value of the business, the greater the safety margin. In other words, investors will be able to buy that stock at a price cheap enough to not suffer a loss, even wrong when making a decision to buy this stock. Phil Town's strategy is to wait until the price of that great business is 25% minus 50% lower than the real value. He will start buying confidently. The more you adjust the price, the more eager you buy. Of course, the practice of investment philosophy is not simple. In addition to a comprehensive understanding of business valuation, Phil Town shares investors needing a strong bravery to keep their minds independent of the crowd's actions. At the same time, it is also necessary to be alert when considering market movements to grasp the majority of the sentiment and to control their rational and disciplinary skills in order to be ready before a coming mission.